And good morning to all of our friends and clients and webinar participants in the West Coast, and good afternoon to all on the East Coast. This is Larry Shavaro, Executive Vice President of First Associates, and welcome to our 7th webinar in our Successful Alternative Lending Strategy series, today Managing Document Risk in Marketplace Lending. As all of our previous webinars are online at First Associates, www.1stassociates.com. This one will be up as well after the webinar, and all participants today will be receiving a link with the webinar as well. As in previous webinars, our agenda is very similar. We'll have a quick 8 to 10 minute presentation by David Johnson, the CEO of First Associates. He'll talk about managing document risk, document verification, custodial in marketplace lending, followed by a few questions. And so please use your question button on the screen on the bottom left to send in questions. If the only questions that we do not get to today, we will send them back to you with a response if we run out of time. We like to keep the webinar to 20 minutes. A couple of upcoming events for First Associates. Next slide, please, Rose. First Associates tonight will be providing and co-hosting the Southern California Consumer Finance Professionals Meetup in Carlsbad. Looks like the weather is going to hold out for us, so hope to see everybody there. And then on Thursday and Friday, First Associates is participating in the California Financial Services Association up in Ojai, California. I will be speaking about securitizations on Friday morning to an eager group of lenders. Next week in New York City, we have the American Banker Marketplace Lending event on Tuesday and Wednesday. And if there's one event that you want to go to this year, go to Lend 360 in Chicago on October 5th, 6th, and 7th, as well as the First Associates and Orchard Meetup in Chicago on the evening of the 5th. The Lend 360 event is one of the highlights each year, and I believe they have close to 1,000 registered already. Next slide, please. Just a quick update about First Associates for those who don't know us. First Associates celebrated our 30th anniversary on March 2nd. The company has been around for many years providing loan servicing. In 2010, new ownership group came in, and we have grown considerably from 6 people to over 220 people servicing a variety of assets: auto, RV, marine, structured settlements, marketplace lending, auto, private student loans, and others. We are located in San Diego and provide primary lease and loan servicing, as well as backup servicing, custodial, contract verifications, paying agent, and soon first-party collection work for many of our marketplace lending friends. Next slide, please. Some of our clients and relationships at First Associates include most of the money center banks, many of the hedge funds on the East and the West Coast, and many lenders throughout the country as well. Next slide, please. Oh, back up one, please. And it's we jumped a little bit too quick. It's my pleasure to introduce our CEO, David Johnson, who's going to share some insights into managing document risk in marketplace lending. David?
Thank you, Larry. Good morning, everybody. I'm on the West Coast, so I'll just say good morning. And it is a bit of a rainy day here in San Diego. So we're talking about managing document risk in marketplace lending.
Good morning, David. This is Rose. Can I ask you to adjust your audio, please?
How's that?
Is that better?
Yes, that's much better.
Okay.
Thank you.
Sure. And it's, of course, something which is very topical this year, as we've seen from the events and earlier in the year. But first, I'm going to start out with some basic things. I think it's well known that First Associates is a loan servicing company. Probably less well known is how much custody and verification work we do. But we do have several million documents in custody at any given time, and that's spread out across North America and Europe as well. So we do have a significant business in that. So to start off, I would start off just by let's talk about what document management risk is, how document verification works, and to do that, I'm going to first just highlight a couple typical structures in the market and talk about how document management falls into that. So on the left of the current slide that's up, you'll see there's an origination platform, there's a lender. This assumes the origination platform is a balance sheet lender in this case. But the origination platform is providing collateral to that lender, and the lender is providing funds back. Now, in this case, that collateral consists of the loan documents, the actual source loan documents. And generally, those are not given to the lender per se, but they're held in custody either at the origination platform itself, at the backup servicer, which is typically First Associates, or sometimes at a third-party custodian. On the other side, you'll see there's an origination platform. They're selling loans to a loan buyer, and then that loan buyer is using the lender to warehouse lend against their purchase of those loans. So the collateral in this instance is passed through from the origination platform to the loan buyer to the actual lender, and the funds travel back in the opposite direction. And the document flow is a little more complex here, but it's somewhat of the same flavor. So how the documents flow. On the left-hand structure, you'll have is a loan tape, which will go from the origination platform to the lender. When it goes in that direction, it's most often called a borrowing base. If those loan documents are staying at the origination platform, really all the lender has is this borrowing base or the loan tape as the funds go back. In the other situation, you've got that same loan tape going to the loan buyer, and then that loan buyer using it to create a borrowing base, which is essentially just a list of loans, and sending that on to the lender while those source documents still reside at the origination platform or a third-party custodial or the backup servicer. And this brings up a number of issues because you can see that the documents that are being passed on to the lender or the loan buyer in both cases are summaries of the actual source documents. They're summaries of the actual collateral. If, in fact, the source documents don't match that borrowing base or loan tape, it's the source documents that rule. Next slide, please. So key questions that come up in these scenarios, and this loan verification, loan document verification is very complex, and I'm trying to distill it down to just a few sample issues here. But typical questions are the source loan documents complete? So for instance, if you have a loan document, is there a signature on it? Is there an actual full address on it? Is every bit of it filled out such that it's an actual legally enforceable loan document? And surprisingly enough, the answer is not often, but is not infrequently, no, it's not completely filled out. And obviously the lender or the loan buyer will not want to have that on the borrowing base of the loan tape. Do the documents actually match the loan tape? So if the loan tape says that a loan was originated on June 1st, was it actually originated on June 1st is the first question, so is the document complete? The second one is that what the loan tape says? Or does the loan tape say that it was originated June 30th, while in fact it was originated June 1st? Do all the loans meet the program criteria? Often we see loans where there is a minimum and maximum APR. So for instance, they're all between 8 and 12%. Are the loans in fact within those criteria? And you have to look at the entire loan tape or borrowing base to see that. So are you actually getting what you're asking for? And it often is APR-based, or it may be state-based, especially when you have issues around licensing in certain states. Borrowers and buyers are often only wanting to accept certain states as collateral, and if you're not actually looking at the source documents, you're not sure that's the case. So is the loan tape or borrowing base itself complete and accurate? Again, the borrowing base or loan tape is a summation of all those source documents, but it needs to be complete on its face as well, meaning it needs to sum up correctly at the bottom. It needs to contain all of the fields. Those fields need to actually agree with each other so you don't have kind of a conflict within your own borrowing base. And then you get to the more generalized questions around, do we have electronic or physical documents? Almost all marketplace lenders have electronic documents. which have their own set of challenges. Electronic documents often have a much greater velocity, and being able to handle an accelerated velocity of documents is definitely, it's a challenge for the custody industry with the legacy players. Physical documents, which we won't really talk about here, but suffice to say, if you have physical documents, there's a whole different set of challenges having to do with the quality of those documents, not just in terms of completeness, but also in terms of whatever you've scanned them or however they've been printed. We have time-sensitive fundings. Often the document verification is the last step before a funding. So if the origination platform is raising $50 million based on a verification program, it really is very time-sensitive and it needs to be done very quickly. And you've got, of course, compliance in the document management activities. Given the alphabet soup of compliance requirements that go along with NPI, you need to make sure that all along the chain the documents are handled in a compliant manner. Next slide, please. So here's an example verification process for a simplified marketplace lender. And this assumes that what would be happening is that First Associates would be taking source documents from the origination platform as well as having the loan tape or borrowing base that they were ready to submit to the lender or the buyer. And the first thing in a typical situation would be just to make sure that the two match. I should say in the background, before it gets to this stage, documents are checked for completeness. So really, if you think about taking it from that point, you've got a set of source documents which have been checked on their own as being complete. And then you go to number one, source document matches the loan tape. John Smith equals John Smith, or June 1st equals June 1st for the origination date. Two, you get to the loan conforms to the program criteria. So the APR is equal or greater to whatever the percentage is, that the loan was originated in one of the states which it is confined to, and a number of other criteria that buyers and lenders use. Three, that the borrowing base itself is complete and accurate. Again, surprisingly enough, this is not always the case, but often the loan tape or the borrowing base has internal conflicts within it, or it is simply not laid out right, or it's not complete. Four, that the borrowing base itself conforms to the criteria. Particularly in the case of a borrowing base rather than a loan tape, you also have issues around concentration limits and other brackets that need to be put around the loans, such that when a group of loans goes into the facility, that the entire facility continues to conform. So this is often done on a cumulative basis rather than a one-off basis. Next slide. The typical output from something like this often looks like this, where First Associates would pull in all of those source documents, the loan tape, all of those types of materials, and then the output from that, which usually goes out within a very short time period, usually within 24 hours or less, would be a verification report, which is essentially a list of loans that says all these loans have been checked and they're all complete and they all match up to the loan tape. The exceptions report, which will say all of these loans are not complete or they do not match up to the loan tape or whatever the issue is, but it will have a reason code on it. Is in the wrong state, does not have the right APR, it's for Jane Smith, not for John Smith, this type of thing. And then an audited borrowing base or a loan tape, depending on the case, that goes out. It's certified so that when the buyer or lender receives that borrowing base, they know that every loan on that borrowing base has been checked and the borrowing base itself has been checked. And at the same time, we will also save an instance of the document, the source document, particularly if we are not the custodian. And by an instance of the document, I mean that since these are generally electronic documents, and if they're custodied somewhere else, we want to make sure that the document that we checked hasn't changed or it can't change. So we want to hold on to, one, the audited borrowing base, and two, that instance of the document we actually checked, so saving a copy of that. That goes over to the that whole batch of reports goes to the origination platform, the loan buyer, the lender, and it also goes into secure storage at First Associates. And that completes the loop from the beginning where the origination platform will submit for the loan facility or to a loan buyer these documents in the loan tape or borrowing base, and the reports that come out of that process such that the loan buyer or lender knows, in fact, exactly what it is that they're buying or lending against. And with that, I'm going to pass it back to Larry.
And thanks, David. That was some really good insight on the managing document risk. We did get a bunch of questions and actually have gotten 3 or 4 of the same questions at this particular point. So I'm going to start with that question today. And it's, it's the elephant in the room that folks are asking, what happened at Lending Club with $22 million in fraudulent loans, and would this document verification process would have caught it?
I thought that question might come up. It's a question that we often get, not just in webinars, but in casual conversations at conferences and client visits. And the answer is this, is that the origination dates were changed. This process would have caught that change. It would have flagged it as an exception on the exception report. And this type of thing happens, and it's not. It's generally not intentional, but there are errors in any base of documents, and that's what this process is for: is to find those errors in that base of documents and make sure that everyone has total transparency as to exactly what it is that they're buying or lending against.
And so to piggyback off of that question from Paul in New York City, when receiving electronic documents, what really can be verified? What are some of the fields today?
Typical fields that are verified tend to be name, first and last, address, particularly the state, the amount of the first payment, the APR, of course the loan number, which then gets tied out, and kind of the the basic fields that you generally find in the till. And that's really the meat of when you're looking at source documents, what gets pulled out of it.
Okay, thank you. And Marcel from up north has asked, do you have the ability to provide these services in Canada?
Actually, we provide these services in Canada today. We provide these services across Europe as well. So I'm going to go with yes on that. It's interesting that, I'm just going to digress for a moment on that question, is that when you think about fintech companies and, marketplace lenders and the industry as a whole, we built First Associates as a fintech company, and it is a marketplace servicer. So the capabilities that we have are much like the lenders have in that everything is digital, everything is in the cloud, everything is SaaS-based. And so when we have these, what would be an enormous challenge for a legacy provider of these types of services, and I'm sure everybody's heard the story that, the legacy providers are often still printing it out, having someone look at it manually, sticking it in a box, putting it on a shelf. We don't do any of that. We're able to handle a level of document velocity which far exceeds that. And we're also able to handle issues around jurisdictional challenges because we use the cloud. We're able to segment off parts of our cloud. We're able to do a number of things that allow us to operate in whichever regulatory jurisdiction we need to be in.
And as you're mentioning that question, that answer, a follow-up question just came through, and I'll end after this question, is that didn't most of the trustees do this work? And it sounds like you're doing something different than they are today.
We are. We're in this part of our business. We're very focused on disrupting the current paradigm. Maybe I should say the old paradigm of how this was done, because it was done traditionally by printing stuff out, looking at it, sticking it in a box, putting it on a shelf, which is just completely inadequate for the needs of today's marketplace lenders. The speed at which things need to move, the accuracy with which they need to be done, the way they need to be stored and accessed by multiple parties are all key to making our industry work. This is, in the overall lending space, a small but vital piece of how marketplace lending infrastructure works. And it's not one that you want to be depending on, kind of a legacy provider to provide in that fashion.
Okay, and with that, we thank all of the folks that have taken time today to pull up the webinar, listen in. Again, all of the webinar link will be sent out to you, as all of the slides as well. We appreciate that, and look for the next webinar, which will be upcoming most likely in the next 6 to 8 weeks. Have a great day, and we look forward to seeing everybody at the upcoming events for Marketplace Lending. Have a great day.